Are you ready for the changes that come with the very humbly named the One Big Beautiful Bill Act? There are quite a few changes with it that retirees, pre retirees, and especially early retirees definitely need to be aware of and understand. In this video, I'm going to talk about exactly what's changing and what stays the same, and how it impacts your retirement plans so that you are fully informed. And there's a lot to this, and honestly, it took a while for me to research and gather all this information so you don't have to. So, benefit from what I've put together and be sure to watch the entire video. First, what exactly is the One Big Beautiful Bill Act? Signed into law by President Trump on July 4th, this legislation locks in many of the most impactful provisions of the 2017 Tax Cuts and Jobs Act, or TCJA for short, which were originally set to expire at the end of 2025. First, we'll talk about the tax brackets being extended and the key permanent changes. The tax brackets from the TCJA are now permanent, meaning the reduced rates will continue beyond 2025. So, what does this mean? With the lower rates locked in, your retirement income remains more predictable. You can plan long term strategies like Roth conversions and capital gains harvesting with greater confidence, knowing your tax landscape won't shift dramatically year to year. It's also worth noting that the following provisions are now permanent. The $2,000 child tax credit is now permanently in place, but with a $200 increase to $2,200 starting this year. This credit remains available for families with children under 17, and the phase-out thresholds are permanently raised to $200,000 for single filers and $400,000 for joint, allowing more families to qualify. Additionally, the bill extends the $500 credit for non child dependents, such as adult children or other qualifying relatives, which is also permanent. This allows taxpayers to claim a $500 credit for each qualifying dependent, which is not eligible for the full $2,200 child tax credit. Regarding the Alternative Minimum Tax or AMT, the One Big Beautiful Bill Act permanently extends the higher AMT exemption amounts originally enacted under TCJA. Currently, $88,100 for single filers and $137,000 for married filed jointly. This means most retirees and middle income earners will continue to be shielded from the AMT entirely. For very high income households, the exemption will begin phasing out more quickly starting in 2026. But for most people watching this, AMT remains a non issue. The 10,000 cap on SALT state and local tax deductions has been temporarily increased to 40K for tax year 2025, with the cap indexed upward by 1% annually through 2029. However, for taxpayers with modified adjusted gross income or MAGI above 500K, the SALT deduction begins to phase out regardless of filing status. The deduction is reduced by 30% of the amount by which MAGI exceeds the threshold, but it cannot fall below 10K. Beginning in 2030, the SALT cap reverts to 10K unless Congress takes further action. Also, the elimination of personal exemptions is now permanent. Before the TCJA, taxpayers could deduct $4,050 per person for themselves and their dependents. Second, let's talk about the deductions: senior, standard, and charitable. First, the most talked about change: the new senior tax deduction. Prior to this bill, seniors already received an extra standard deduction of $1,850 for single filers or $3,000 married filing joint. The new law increases these amounts to 6K and 12K respectively, triple the previous deduction for those age 65 or older. These new higher deduction amounts take effect for the 2025 tax year, so they apply to the tax return you'll file in early 2026. Some headlines earlier in the year incorrectly claim this bill would eliminate federal taxes on Social Security benefits, and that's not true. While Social Security is not completely tax-free, this much larger standard deduction means that for most seniors, a significant portion, if not all of their Social Security benefits will now be tax-free. The new senior deduction phases out at 75K for single filers and 150K for joint filers and is temporary, expiring at the end of 2028. So if you're a retiree under these income thresholds, this is a great thing to take advantage of while it's available. In 2025, the base standard deduction has increased to $15,750 for single filers and $31,500 for married couples filing jointly, thanks to inflation indexing and the One Big Beautiful Bill Act. These amounts are about 8% higher than the 2024 figures of 14,600 and 29,200 for joint. Also starting in 2026, taxpayers who claim the standard deduction will also be allowed to deduct up to $1,000 for single filers or $2,000 married filing jointly in charitable contributions, a return of a popular provision that had expired. The third thing to talk about is the good news that capital gains remain stable. Capital gains tax remain the same under the One Big Beautiful Bill Act. Top rates are still capped at 20%. But keep in mind, if your MAGI exceeds 200K for single filers or 250K for married couples filing jointly, you may also owe the 3.8% net investment income tax on applicable investment income. No changes to the capital gains tax rates is a big relief for retirees relying on investments. This means you can continue to realize gains up to those limits without triggering higher taxes, an important planning lever for funding early retirement. Fourth, there are new deductions for tips, overtime, and auto loans. This part of the video includes two distinct temporary deductions, and the eligibility rules differ for each. First, the overtime and tip income deduction. If you're still earning wages, whether you're not yet retired or you're retired but working part-time, seasonally, or are doing gig work, you may qualify for a new above-the-line deduction. Single filers can deduct up to $12,500 of qualified overtime premium and or tip income. Married filing jointly can deduct up to $25K combined. To claim the full deduction, a significant portion must come from tip income. This decision begins to phase out once your modified adjusted gross income or MAGI exceeds 150K for single filers and 300K for joint. Second, there is the auto loan interest deduction. You can deduct up to 10K per year in interest on auto loans for vehicles assembled in the United States. This deduction is not tied to employment. You may claim it whether you're working or fully retired. However, the deduction phases out for individuals with income over 100K for single filers and 200K for married couples filing jointly. Both deductions are temporary and are available for tax years 2025 through 2028. Fifth, let's talk about a big one, healthcare impacts. Here's where the bill may hit early retirees the hardest. It's important to clarify that the One Big Beautiful Bill Act did not include any provisions related to ACA subsidies, neither to extend the enhanced subsidies or to repeal them. The issue at hand is that unless Congress passes a separate law before the end of 2025, the enhanced subsidies, which eliminated the 400% FPL cliff, will expire. So while this bill didn't directly roll anything back, the absence of an extension effectively means we may revert back to the old rules. That would bring back the dreaded subsidy cliff at 400% of the federal poverty level, a steep drop off where just one extra dollar in income could disqualify you from all premium subsidies. For reference, in 2025, 400% of FPL is $62,600 for a single person and $84,600 for a couple. You may have already seen or heard that many healthcare policy groups and news organizations have warned that if Congress does not act, millions could face substantially higher monthly premiums starting in 2026, potentially doubling or tripling what they currently pay. But here's some good news. Starting January 1st, 2026, bronze plans sold on the ACA individual marketplace will now be treated as high deductible health plans, making them eligible for HSA contributions. That's a major change, especially since bronze plans offer lower premiums and were previously excluded from HSA eligibility unless they met certain criteria. So there you have it, all of the major changes with the One Big Beautiful Bill Act that I thought pertinent to pre- and post-retirees. If you found this video helpful, please don't forget to like and subscribe. And if you're ever on the go, listen to the Early Retirement Roadmap podcast, available wherever you get your podcasts. And go to mikeupland.com for all of my media, including my blog. Until next time, thanks for watching, take care, and make the most of today.